just do some quick introductions. Dirk, you didn't introduce during yourself. You held on for this point, so let's start with you. A quick introduction of yourself and the company, Dirk.
Well, I'm Dirk Bakker. I'm the head of Europe, Middle East, Africa hotels for Colliers, and I'm CEO for Colliers in the Netherlands for the entire real estate sector, basically. And been in the hotel industry for 30 years, global markets, and specialized in advisory, new concepts, and M&A projects, basically.
Great, thanks very much. Charles, let's come to you at Aareal.
Yeah, hi everyone. I'm Charles Combet. I'm working within the hotel and student housing department at Aareal Bank. Together with our local hubs, we are operating, originating, and structuring senior financing from Canada to the Maldives, basically, with, of course, a strong presence in Europe. Our portfolio of hotel financing is over 8 billion euro, which represents 1/3 approximately of our bank loan.
Great, thanks very much, Charles. Asli, let's come to you.
Hi, Richard. Good to be here, and thanks for the invite. Hi, guys. I'm Asli. I'm the Chief Development Officer of Cycas Hospitality. We are a pan-European hotel management company. Currently have under 6 brand chains, about 17 brands at 28 hotels in 5 countries. So we're pretty brand agnostic, white label hotel operator operating across all segments. And also under hotel management contracts, leases, and JVs and co-invest.
Great, thanks very much, Asli. Jochen.
Yeah, my name is Jochen Suren. I'm the Chief Executive Officer of the Hotel and Leisure Division of Principal Real Estate, which is a listed American investment and insurance group. I have been in this sector for also over 30 years, and working for hotel groups like Hilton, Meridian, then afterwards for Lazard, Invesco, and then set up our own company, which we sold to Principal a few years ago. Interestingly, we don't have a lot of hotels left. In 2017, we had 18 hotels, and we sold them all except for one by the end of 2019. Not because I've got some crystal ball that told me that COVID was coming, but because I thought if I can sell for 4% turnover leases, then I'm selling. So that's what I did. And now we're basically looking for opportunities. Anyway, I look forward to the discussion afterwards.
Great, thanks very much, Jochen. Gerd, coming to you at CMS.
Yes, well, CMS is less a company than a worldwide organization of law firms with a very strong tax arm. We have more than 5,000 lawyers and tax advisors spread over 70 locations in more than 40 countries. And I'm a partner in CMS Germany in our Berlin office in the corporate department. As a firm, we have a full service approach, which allows us to build a strong sector expertise that we can make available to our clients. So we have the full range of advice available, and in COVID times, we could even advise our clients on how to obtain government grants for COVID support. And in that context, we have a very strong hotel and leisure industry focus group, which is present worldwide and well established, if I can say that with all due modesty. The period from February 2020 has, of course, been a very special one also for us. And our our legal advice has shifted more towards renegotiation of joint ventures, lease agreements and management agreements. But even during that period of time, we have had very interesting and motivating transactions that were not at all distressed. And I think it continues this way. I'm currently involved in a very intense transaction that takes place in Berlin, where I sit, and I look forward to our discussions now.
Great, thanks very much. That focus around motivated sellers and those kinds of things will, for sure, will be something we'll pick up. And last but very much not least, Frank.
Yeah, hello, good morning, everyone. Frank Hildwein from Deka Immobilien in Frankfurt. I'm running the acquisitions for the group for hotels, and we have about a portfolio of about 4.5 billion of hotel in our total funds. So we are running institutional funds and also retail funds with a volume of close to 50 billion. And yeah, about 10% out of that is invested in hotels. And we are still active in the market. It's not so easy right now to find hotels. We will talk about that a bit later, but now we've been through all our asset management issues. Over the pandemic, we are focusing again on transactions, and I'm looking forward to this conversation, to this discussion.
Great, thanks very much. So as you can see, really good spread of expertise, both across Europe, but also from different perspectives within the sector as well. Asli, I wanted to maybe just start with you. I mean, business and travel, tourism drives significant demand in the sector. So how are you seeing the current market? And I'm just wondering whether there have been any sort of, I mean, we're all aware of the negative impact, as Dirk mentioned in the presentation. But I mean, I'm just wondering whether there are any positive surprises for you, or how, I guess, you characterize the market.
Thank you, Richard. To be honest, we were a bit on the lucky side of the operator spectrum because, of course, as you know, although we have all segments of hotels from full service to limited service, we have quite a big portfolio of extended stay hotels, which when we start 13 years ago trying to explain the market upside of the extended stay hotels, we're certainly not expecting COVID, but what happened is, of course, during the last 15 months, all of our extended stay hotels pretty much traded at a GOP break even or more, which, of course, not big surprise for us, but I believe that was a big surprise quite a few other people in the industry. So fast forward to this year, what we have seen in terms of the trend and change, and we've seen in operating in 5 regions, we see a big change in the UK market, especially UK provincial markets. Month after month, we've seen our Dundee and Liverpool properties beating our London Vauxhall property in the RevPAR and recovering much stronger and faster. And in Europe, we've seen this recovery becoming quite much slower. I think, of course, it's linked to the vaccination and relaxation and approach. But at the end of the day, we all knew that this is going to be a bit of a journey for everybody. So we expect the trends to come back in the next, probably in the next 6 months, we see a bit more positive movements. But I think the actual recovery to whatever we're going to claim the recovery to be, what everybody currently say the recovery is when we reach back to 2019. So if that's the case, then I think we still have a good 24 months of journey to get through this in this current market.
Okay, good. And Frank, I'm just wondering when you're looking at the market, I suppose Dirk mentioned there that there'll be a kind of strong recovery. What are you building into your kind of strategy and your views going forward? I suppose how fast and how deep will that recovery be in the sector, do you think? I mean, I know we're guessing, but
Yeah, of course, we all learned a lot during the crisis, and our focus has always been on business hotels in the metropolitan areas of the large cities in Europe and also overseas. And we have been buyers of Novotels and Holiday Inn Expresses. I would say probably everything which is a business hotel between 2 and 3 and 4+ stars. Maybe not so much on the luxury side, on the 5-star side, but and we were running now with our operators. We are all holding our hotels on leases through the crisis, and we were trying to help each other to go through. And with the lease approach, it was really difficult for the operators as well to survive on that crisis. It's been hit very hard, and now what we really have learned is that it's probably not so safe only to have business hotels. So as we can see now is that the Baltic Sea, up in Germany, hotels are really making a lot of money there. Not so much on business hotels. The conference business has been hit really hard. So what we will probably do is that we will adapt our strategy and we will maybe go more into the leisure segment And what Dirk also said is, I absolutely agree on that, that we probably need more kind of community hotels where we have a different guest experience and people can really work there and have a home office approach, with other people to connect. And also the extended stay sector, our extended stay hotels, they have, I can really go here with Asli that we need to see that the extended stay business has break even a lot quicker than let's say a 4-star conference hotel. So this is really the lessons learned, and that will also change our focus on our future acquisitions.
The most interesting question for the sector as a whole is effectively what we talked about earlier, is what is the new normal? Because we have a complete reversal of the historical trends where, historically the capital cities were doing really well and you could achieve ever higher average rates. And now it's destinations that some of us have never heard of, which are selling their rooms for twice the price that historically they've done, in particular leisure destination or second or tertiary markets in each country, which can be reached by car. And the real question is what's going to happen going forward. And I think what the real question is here is we have a cyclical and we have a structural impact of the crisis. And the cyclical you can actually ignore because that's just going to come back. The more value-driving long-term issue is what is actually the structural change? And then you start talking about the technological advances that have been used over the last 16 months, like this one. They will not disappear. And this will particularly hit business travel, mostly, of course, conferences and congresses. And that has huge impact on some assets. And the issue that we have right now, and I always find it so funny when you listen to various people, and I see it myself, that transaction pricing hasn't changed. It's incredible. In an incredible period of uncertainty, we have the same prices or cap rates as before, despite the fact that a lot of operators are under huge stress and quite a few will disappear or merge or something will happen. And hotels will not have the same profitability because if you get rid of a lot of Congress nights that are being sold at 3 times the normal average rate and they disappear, well, it's difficult to replace that. So you have a huge impact on cash flows and operating profitability. So it's fascinating. So we are actually waiting because I think the real crisis will come in 22, 23, when actually people realize that there's not going to be a return to the old normal.
Yeah, and I think there is one aspect that should be added, and I would be interested in hearing participants' views on that. It's the trend to sustainability, which has been a strong trend before the crisis came, and I think it will now tie in with the consequences that we have to draw from the crisis and from this stress test that the ecosystem has been exposed to. And I think it is relevant on several levels. It's the level of demand, of course. People's demand behavior is changing under that. In that respect, they are asking for more sustainable products, whatever sustainable means. That remains to be defined and advertised. But it's an important aspect, I think, and also on the regulatory level. I mean, it's something that's upcoming, and there will be more and more regulations that will be imposed on the operations. So I think those trends also need to be taken into account and will tie in with getting back to new normal.
Yeah, I mean, I think if I can react to that, Gerd, and also to you, Jochen, I mean, there's a few other trends outside of our industry that will affect travel, and what you've seen is that in major cities, prices for housing are going up. A lot of young people cannot afford to buy a house anymore, so you get new forms of housing. So more community housing, more student housing like forms, more hybrid hospitality forms will come into play just because of the pressure of the expense of being expensive to live in cities. So that's one. Secondly, the structural trend remains to be seen, Jochen, is business travel. Leisure yes, will come back very quickly. People have disposable income. People like to spend their money on experiences. Instagram is still very popular, and sharing experiences is even more important these days. But business travel is the major question, and the second major question is, when will long haul come back? The Chinese, there's only a few percent of the Chinese prior to COVID, the COVID crisis was traveling. They will start increasing their travel, and for sure to Europe, because Europe is still the #1 destination. How will that affect the way we lodge them and everything that comes after that? That remains to be seen. And yes, Gerd, sustainability is a major issue, and it will become increasingly so. Within the next 3 to 5 years, you'll see that you cannot get around it anymore. There will be taxes raised to be able to reinvest back into sustainable factors. Business travel, in my view, is going to come back in a different form. You know, and we discussed it earlier, the Teams discussions that we have over screens, the security issues that are tied into a Teams call for business purposes, with people leaking information, IP issues that come to the table is too risky. So people will have to see each other after all anyway, and relationships are not built over screens, they are built in live form. So in that sense, also conferences will come back. In what form? That remains to be seen. That's my view.
Okay. Just one perspective on this. I think we've all been to MIPIM and to the Berlin Hotel Conference. And we've been quite a few of us have been in the business for a long time. I remember times when the Berlin Hotel Conference was a few hundred people.
Yeah.
I remember times when MIPIM was 1,000 or 1,500 people in the 90s.
Yeah.
And the last time I went to both, it was 22,000 at MIPIM, and I think 2,500 or 2,300 people at the Berlin Hotel Conference. I think there's so much space between these two. And I don't know, my impression for the last few events when I went there before COVID was there just too many people, way too many people for quality. Now, if you think about what happens if only 30% of that goes away or is replaced by virtual participation, it will have a huge impact on hotels. And what I anticipate is effectively, it will take some time to realize. The crunch will come when refinancing for hotels will come, because right now to push things through and to just keep the status quo is very easy when you pay 1% interest. But when you have to refinance, the question will come, and I think that will be later in 22 and in 23.
Can I just add something on that one, Jochen? What you have said that is going to have an impact on hotels, and you're right. I think what we were long overdue was a market adjustment in hotel real estate in deal structures. I think, especially in 2019, some of the deals that were taking place, especially in Europe from a lease perspective, people putting leases like, the fashion is going out of fashion on secondary location, more than 10,000 a key, 100% triple net. I mean, I'm born and bred hotelier. Before I did development and investment, I run hotels, and it's impossible. It was impossible to sustain type of deals that were taking place. And the same goes from a financing perspective. I think after 2011, LTV adjustment actually came into play, so therefore it was good, but still there were some yields applicable into certain assets, and return expectations were just either too greedy or too ambitious. So I think, without wanting to happen, it happened. It's going to have a big impact on just to readjust our market and get to the sensible levels of not to be greedy, both for landlords and tenants and operators and brands. And we will just get a bit more sustainable market level for all of us, for the sake of all of us.
Great. And Charles, that leads neatly to you. There's been a lot of discussion there around the financing side, refinancing side, and obviously you're seeing it from a different position in terms of, I suppose, what you're looking at financing. So I guess maybe let's just do a quick overview of the financing side, and particularly, I suppose, what you are and are not financing, and your activity in the market, how you see that.
Yeah, sure. Look, from the Aareal Bank point of view, we were active in 2020, we are active in 21, and we will be active in 22. The reason is that we believe on the long term of this asset class. I mean, last year we have closed a transaction above 300 million for 7 assets in 5 different countries. It was in June, so at the peak of the crisis. We currently are looking at transaction, maybe less than usual, but we're still looking at some transaction. What we are seeing in the market, in some banks have withdrawn or put a hold on their financing ability, where you have some new players or alternative lender entering the market, but with higher margin. As what we are seeing and what we are doing is that our approach is a bit more conservative in terms of LTV, and pricing is slightly higher, but still the all-in rate remains attractive for the investors. So we see a lot of capital out there, even some new funds being in the market that are looking at opportunities, opportunity being potential distressed assets. But the question is, are they distressed assets in the market? And that we don't see it there yet. Okay. And you were mentioning what are exactly our target at Aareal Bank, etc. I mean, traditionally, we have structure or we're targeting prime assets in large cities with a strong mix of leisure and business. This has been and this stays our target for the bank. But that being said, we can see a diversification in the hospitality industry that was before the crisis, and that is accelerated during the crisis with for instance, serviced apartments, regional markets, resorts, and also student housing. And us, as senior lender active into the hospitality industry, we are open and ready to enter those markets and to finance as well those diversification.
Can I just comment one thing that I'd like to say in this regard? Aareal has been in the hotel business forever, as long as I can remember. And you've always been one of the guys with the higher margins and the more expensive pricing, which, you know, all goes to the credit of Aareal and their risk management. But the typical mortgage banks, whether it's in Germany, France, or Spain, has, based on our experience, is gone. They do still financing if it's existing clients, but truly new financing today by the traditional lenders is gone, in my experience. Who are coming, you're absolutely right, are the opportunistic debt funds, which are charging not 1.5%, but 4%. And I would categorize that not as, let's call it traditional hotel financing, but some kind of semi-equity, if you like, that essentially is a new form of funding. But it's not the traditional hotel mortgage funding we've seen for the last 10 years.
Exactly, Jochen. And as you say, we are active and we remain active into this industry because we are also people that understand the operation, that put our hands into the P&L, that really want to see the numbers and are working with clients or sponsors that have a long-term view of the market.
I don't dare to ask you what margin you're charging now.
Well, you can dare, Jochen, but Charles is also free to not tell you, I guess. So.
As I said,
good on you.
No, but indeed, the margin of the whole overall market has increased. This is market. We see this in the markets, but still, the all-in rates remain very attractive for the investors.
I've got a couple of questions that I just want to come to that are coming in from the audience, and I just want to pick those up. So first one that came in was from Andrew Peterson, which is, what do we think about changing use of hotels to a mix of overnight stays, midweek stays, and then longer stays of 1 month, 3 months, or even longer, all with more flexible pricing? So I don't know whether anybody wants to pick that up. And also from Simon Wallace. Hi, Simon. Good to see you as well. Do we see a risk of hotel operators going bankrupt? So I don't know. There's a couple of things there if anybody wants to pick those up.
Well, I mean, I don't mind saying something about new trends, because longer stay, yes, it basically will happen. Hotels will have to adjust. I don't see anybody staying very long in a Holiday Inn Express. But yes, in suites, in more luxury hotels, but also in a 25 hours hotel or a Zoku hotel or an extended stay formula. These kind of hybrid forms, as I also said earlier, will absolutely start happening, but the industry will adjust. There will be other players coming into the hospitality industry as well that will make a mix between, let's say, for instance, Airbnb-like situations and hotel forms. That will happen because the pressure on tiny houses, on smaller and multiple houses, subscription-based living, those kind of concepts will certainly, you'll see those coming in the next years to come.
And Richard, I can answer perhaps on the operator side, as being an operator, perhaps. Look, listen, I think I mean, from a Cycas perspective, we are lucky because we made some structural changes in our company and vision back in 2019, and then into 2020 as a combination of always a stronger management on board, plus our shareholder, Thai investor being a big, supporter of our company. We have seen through the 2020 much better compared to our competitors. We are very mindful of the next 12, 18 months, but we are in a good position. And we, in fact, seeing that institutional investors are no longer as active as they were. We're now looking and working with our private capitals or private equities to co-invest and grow our partners. But saying that, one most important thing, everybody had a bit of a lot of support on the past 15 months. Most governments, incredible support, and banks and all that, great. But now the next 18 months, we all gonna fight with the full inventory in each market, with the quarter or half of the business that inventory was able to deal with 2 years ago. Now, if you haven't got the right talent and operationally in your teams, if you don't have the right commercial and structural mindset, and all this furlough schemes and government supports come to an end, bank moratoriums come to an end, it's going to be a bloodbath. So, and I think everybody had pretty much a good time to think, reflect, and prepare. But we've seen already some changes happening in some of the big operating companies. They selling their shares at a very cheap just to get that cash injection and etc. So I think the actual danger all the operators will be facing is the next 18 months when there isn't a cash flow and there isn't a support. And we're going to see, I think, a lot of mergers or private equities, injecting cash and buying a big part of the share in these operators, which, probably not everybody's desire after spending so many time building their company.
If I can just add to that, in our experience, we have actually seen several operators go bust, and I'm not going to give any names. And I could not agree more with I forgot your name. Asli, sorry. I think it's going to be traumatic because on top of it, we have legal constraints in terms of kicking out tenants. I would also say that the PR position is very bad. Nobody, whilst the COVID crisis is still ongoing, wants to, create a bankruptcy, etc. And banks always try to find a solution. The next 18 months will be very, very interesting. And that's what I was talking about earlier, 22, 23, because there will be tons of operators when all these furlough schemes stop, when the legal restrictions in terms of evicting tenants go and etc. And when the whole recovery shows to be taking longer, there will be a lot of blood in the street.
And that's also the reason for, that's why probably we don't see that many transactions at this time, because it's also an operator issue. And and as I said before, we have been dealing with our tenants over the last months, and some behaved very good, and some were more difficult, and some are more in distress and some less. But of course, if we buy a leased hotel, then the covenant of an individual operator is of course key. And covenants to underwrite at this time is incredibly difficult. You just don't know really how much cash was burned over the last 18 months, and how will that operator come out of that crisis. And, you know, if you look what happened in 2018 and 19, then, you know, the market was really booming, and a lot of operators, they just signed leases, you know, on really high lease levels. And if these leases really materialize and these projects get finalized, you know, and they have to pay that rent on a basis which is difficult anyhow right now, and you don't know how the market will perform over the next month. So this is a really unknown, and this maybe also will change the operator market, and this is where also we see the biggest changes, that you will see maybe some bankruptcies and also some operators being bought by PE funds and so on and so on. So that's the difficult part right now.
That's going to be what I was mentioning as well earlier on, Frank. I mean, look, in 2019 probably was Cycas' most successful year. We added 10 new hotels or 10 new signings into our portfolio. That year we could have signed 20. But again, because we know this market is cyclical, without even thinking of COVID, we just couldn't match. We couldn't just digest to put such leases. Well, and we only signed 10. And of course, our business model is 50% management contracts, 50% leases, and conservative leases. So that was always a very important play that played out well for us last year. On top of that, because we were a bit more sensible as an operator, I think we are probably one of the only operator in Europe. We opened 11 hotels since October last year across 5 countries. We didn't walk away, we didn't delay, we just opened because deal terms were sensible, either with our operating owners or the landlords. And yeah, I think I can just see this in 2022's first quarter. I think the lease market that need to open their development leases that were signed back in 2018 to come completely crashing. And that's going to be very interesting where we're going to end up with that.
Yeah, and some operators, they may not even be able to take over the assets.
No, well, exactly.
I heard right now of a deal where the operator, on the day of handing it over, they just couldn't provide the bank guarantee.
No.
And the cash deposit was also not possible. So the developers said, and the investors said, no, sorry, you cannot take over that asset. And of course, that's a big issue right now. If you don't have an operator, what do you do with the finalized product?
Yeah.
And if you see that, and also for us, we wouldn't take over a development. We bought on a forward deal and with an operator where we are not sure if they will survive the next 18 months.
Yeah.
And issue.
If I could just add a story from our portfolio, and I'm not going to reveal the name. What we did over the last 3 months is we had one operator which we had taken on from a already existing deal, development deal, which was fine before the crisis, but it was a family business. They got into difficulty, and we made a deal with them at the beginning of this year to get the property back vacant possession by giving them back their bank guarantee, but getting the hotel back without any restrictions, because we didn't want to get involved in the bankruptcy or the legal procedures, etc. So we made a deal to actually take the hotel back. It was a brand new hotel. And within 2 months, we found a new tenant, much stronger covenant, but a completely different lease. Basically, it's a completely hybrid, convertible, structured lease, which allows us over long term to basically get back to where we were and even more. But we basically took the action to avoid long legal disputes and switched it around. And the quality of the assets allowed us to do that. And I would recommend anybody to do similar things if they're in that situation.
That's right, Jochen. I think in France, actually, there is this, the difference between the leasing the going concern versus leasing the property.
Yeah.
So location gérance. So what we are currently providing to some of these institutional investors in France, they have these tenants that just basically about to crash. It is silly. I will never put a lease today and take over an existing hotel because I'm not gonna, we will repeat the same thing. So for an interim solution, we're providing location gérance where we are leasing the going concern and not the real estate. Therefore, the employee stays with us. We manage the hotel on a fully variable lease on the NOI level, so that get the building going and recover. And then we have an agreement that in 3 years' time we set a bar and say, okay, we will do the lease if we can at this level, or we'll just basically hand over. And that's the sensible thing. I mean, we were a bit more optimistic perhaps earlier this year and look into some takeover leases, but then as the vaccination delay and new variants, and our board very quite rightly and ourselves, we decided, okay, takeover leases in that old sense is definitely a very silly idea, but let's be creative, because we have such a strong talent pool. We open all these hotels with a bigger teams, and we very much self-sufficient from a cash flow perspective. So we all gonna become so creative and find different ways to, help each other. And that's what's gonna happen.
I think that was a good situation, this stress test, to find methods to find a new equilibrium together. I mean, this is a very generic remark, but I've seen that in the negotiations. I've rarely seen negotiations between tenants, landlords, and also franchisors or banks that were very, very rude or disruptive. It was, at least in Germany, I can't tell how it is in other jurisdictions, but at least in Germany it was more or less constructive, what I saw.
I just wanted to pick up with you, Charles, if I can. Just Dirk mentioned, obviously, and I'll come to all of your questions shortly, because there's a lot, and we'll try to pack as many of them as we can into the last kind of 12 minutes or so. But Charles, I just wanted to pick up with you on the international capital side, because obviously Aareal, operating globally. So what are you seeing in terms of, I suppose, capital interested in the sector, particularly in Europe? And are you seeing differences between that, in terms of that perspective between maybe Asia, North America, and Europe?
Well, look, about those jurisdictions, if we look at Asia and the US, they had a faster recovery on their markets compared to Europe, right? Due to some vaccination campaigns, or jurisdiction-wise in the US, business goes faster than Europe. So we see that in those markets, the situation is much better. We had for instance, some hotel in Australia that performed still good due to their domestic demand. And we see some of those capital that have grown and developed more in those countries or this continent that are still trying to enter Europe, looking at distressed assets. So if you look at the STR data, you can see that Europe is lagging behind. We're all waiting for the vaccination campaign and reopening of the border, because in some large cities that are highly depending on Asian or US tourists. But once again, on the long run, London, Paris will remain attractive cities for hospitality.
Great. I'm just going to run through some of these questions, and we'll have to try and be brief for you, I'm afraid, in order to try and get as many of these in. But if not, we'll try to come back to you afterwards as well. So this is from Antoine. Thanks very much, Antoine, for this. Post-COVID, in order to have a better alignment between operator and landlord, do you think that there'll be more and more HMA versus lease agreements? So that's one question. And the other one is from Alexander. Thanks very much, Alexander, for that, which is, what's the future for conference hotels? Which is quite interesting. So if anybody wants to pick up either of those points.
Well, I can answer the HMA question. I think what we'll see is that, well, today we have the most attractive options are either a franchise or a lease. HMA is the worst of all. So I think we will have a situation where those people who can take on operational risk and have the ability to do that will tend more and more to franchises. And that those who, for regulatory and other reasons, have to have leases will obviously all go to leases, but there will be variable leases. The times where we have fixed leases with fixed rents for the next, whatever, 25 years are over for at least a few years. And there will be all sorts of options how you convert that, but that's it's going to be leases, variable leases or franchises.
I'm going to very disagree, very much disagree with you, Jochen, I think, on your view on HMA. I think the fear in Europe that the quality management platforms did not exist over the past decades. You're right that I think HMAs were very one-sided, and HMAs never actually proven in European market to be something strong. But if you look at US market, there's literally 99% of it is HMAs and 1% are leases, or, you know, compared to Europe. So you have likes of Ambridge running more than 1,000 hotels, Davidson Group, Primit, and etc. I think what's going to happen is that over the past 20 years, I think Europe has started growing some really professional management companies. And these companies, like us, obviously we're getting stronger and better, and the market is becoming more used to have a professional management company. And of course, management companies that put a little bit of skin in the game, like us, you know, either be by co-investing or promote options and etc. So the good old 10-year vanilla HMA, no termination allowance or massive fees, and no performance, clauses. Of course, we're not talking about HMAs now. I think we're going to have more and more HMAs in Europe by the professional management companies, not brands.
Okay, let me just clarify. I was talking about HMAs with the major hotel groups.
Oh, yeah.
HMAs
Okay.
with the white label is actually one of the trends which will continue. I agree with you.
Yeah,
sure. Okay.
But maybe I can add here. But within Europe, of course, the lease model has been the most established. And if you look back at the transaction market, so in 18 and 19. Prices were really high and yields were pretty close to, I would say, office yields. And I probably agree with Jochen that the leasing market will change from more fixed leases in more hybrid models. Yeah. But this for sure has an impact on pricing. And I don't know what happens then. Then you probably won't see that many transactions. And if you look in the transaction market today, then you see, what are the most expensive assets, the lowest yields. It's probably a Motel 1 in the Premier Inn with a fixed lease and a good covenant. So if we move away from fixed leases to HMAs or to hybrid models, we won't be able to pay the same price probably. Charles, I'm not sure if he would finance that.
Yes, actually. The HMA is something that is a key point in our financing. Of course, we can finance lease, but we very much like HMA because we can put our hands into the P&L and look at the performance on a weekly basis, so to say, right? So this operational part, especially during the crisis, it is something that has been key for us to really understand the situation of the hotel and work together with the borrowers.
But the HMA with the major hotel groups doesn't give you any control. They may give you information, but it gives you no control whatsoever. So the only option for attractive HMAs, and that's where I agree with Asli, is that HMAs with white label, because there you can have all sorts of termination clauses, more incentivized structures, more involvement, more approvals, etc.
I think one thing I must admit, the way I explain to the market why we do leases as Cycas, which is a white label operator, a lease is the only way I can secure a full 25-year uninterrupted management agreement. I'm not doing leases as a white label operator to use that as a financial tool like some other people does. So, but I can't get a long-term base in each of the new regions we enter, therefore we sign leases. But it's the most expensive damn mortgage to have a lease at the very high interest rate. So ideally, I think the market, once it's kind of balances itself out with the next 2-3 years with the current leases and institutional investors and market caps, etc., there is going to be a very different market in yields and investment transaction window. But I don't have, of course, the full crystal ball to say what it is going to look like.
Just one word. The real opportunity today is for operators to sign fixed leases at very low level that institutional investors agree and accept, which in 10 years' time will throw off tons of cash flow for that operator who signed that fixed lease now at a low level.
Okay, good. I've got a couple more. I obviously need to do a separate session just on this point.
Yeah.
we will come back to this topic for sure. I will make sure that we do another session which looks at this. Really interesting topic. Just a couple of things that I really wanted to pick up. The conference hotels part of it, and there was also a question from Patrick. Thanks very much for that, Patrick, which is, are investors ready to leave the sort of, I guess, secure conference hotels, business conference hotels, and invest in more of the emerging trends that we're talking about, which may require an acceptance of a real or perceived risk. So I don't know whether we can wrap both of those questions up in a single one from anybody.
Well, what I can say probably is that if I would present a conference hotel to our investment committee tomorrow, you know, somewhere on the outskirts, 500 rooms, big conference facilities, I probably won't get a positive feedback because it's just too uncertain how that market will change within the next years.
Okay, good. Another question as well here from David. Thanks very much, David, for that. Which is, on resi, do you see a decrease of average studio apartment size because of the impact of micro apartments? And is this likely to lead to an alternative use for hotel space? So interesting one there as to whether or not there could be there could be conversion from hotel into resi even.
Well, I think if I can just answer that, clearly over the next 3 to 5 years, we will see a significant reduction of hotel supplies, i.e. the weakest hotels, worst located, etc., they will get out of the market. And there will be lots of conversion opportunities that could be converted into student homes and all sorts of resi, into whatever else. So I think that's definitely going to be a trend. Now, I'm not able to answer this question about the micro space. That is too detailed. I wouldn't be able to answer, but there will be a conversion opportunity of hotels that have to go out of the market. And obviously it will depend from market to market.
Yeah, I would second that, Jochen. I can already see in Amsterdam that it is taking place. All the loans, basically the shorter loan, the smaller loans of 2, 3, 4 million euro loans are obviously the people that have those kind of loans have been eating from that loan and also had to operate their business. And they're typically the kind of hotel operations that have not been the forerunners in investing in their property because they've been riding the waves on an overcooked, overpressured supply market. So these are the kind of hotels that will disappear first. Agreed.
And there's a quick question here as well from Omar. Thanks, Omar. Do you think the new trend for the hotels to adjust their prices due to quarantine, and how they see this from a consumer side and from the investor side? I suppose wrapping that up, that's more about, there's obviously been an increase in pricing for hotel rooms more generally. Is that the sort of thing that will stay after COVID, or will we see new pricing based around that, or is that going to disappear?
Pricing from a room rate perspective.
From a room rate perspective. That's what I
think
took it to
the supply was low. Yeah, I think the supply was low. Of course, there was so many hotels closed over, the COVID period and etc. And I think there was a little bit of a, those who were open probably saw a bit of a higher rate. But no, I think we're going to see some adjustments as the market comes back. But I don't think we're going to go back straight to what it was 2019 straight away.
Okay, great. Now we're almost out of time. So I've just got one last question which I wanted to pick up with everybody, which is, I suppose, given where we are in the market at the moment, where do we see the opportunities? So if there are people looking to invest, where do we see the opportunities? You can take that as geographies or segments of the market. So let's maybe start with you, Dirk, in terms of where you see the key opportunities.
Going forward?
Yeah.
Well, as I said in my presentation, I think more mixed-use opportunities, more community-based opportunities will come into play. I think if you go into secondary cities, I think the major cities, there's a pretty healthy mix of supply as it is. You may see a bit more shift towards restaurants from outside managed restaurants into hotels. To blend in more with the community. I think that might be a first step to bridge from a business hotel to a more like leisure kind of opportunity that will happen. I think in the secondary cities, there you will see more modern products coming in that do not only offer lodging, but also offer an experience where the local community and tourism can meet each other. And I think that's a trend that you will, it's not going to be a trend, that's going to be a structural change. I think we've discovered during COVID that wherever you live, that your own country is actually a very beautiful country. You don't really need to go abroad to see more. People always find the sun, but certainly the domestic tourism will get a permanent boost out of the COVID, coming out of the COVID crisis. That to me are the major trends that you will see. Last one is more mixed use.
Okay, great. Gerd, where do you see the opportunities? And you can stick to Germany should you wish.
Well, basically the opportunities are everywhere. They are everywhere as long as the amount of money is around. Of course, that may look different when the available money is not that big anymore, but I think it's everywhere. It's in A cities, of course. It's in B and C locations, but there, of course, you will have to scrutinize very thoroughly whether the location and the site is ready for future requirements. Again, sustainability and also changed customer requirements.
Great, thanks very much, Frank. What's your kind of view?
Well, I would say that the biggest opportunities for me right now is probably more on the operational side, on the operator market. That market is very fragmented, and over COVID, with all the distress you will see, there will be some consolidation. So we don't have the right money for that. We are not a PE fund. We are a traditional real estate investor. So we are looking more on the real estate side, and what we are looking at is, on one hand, on hotels with good covenant with operators. That's not a real opportunity. That's probably more a thing how we can do transactions and how we can present that to investment committee. On the other hand, also, I would say that vacant possession real estate is something we are looking at right now, where we can put new operators on and have a good start with a new lease and take it from there.
Great, thanks very much. Charles, what's your perspective on that?
Yeah, well, look, Jochen and Frank had a pretty elegant solution with the cheaper lease, so that's a good one taken for this conference. But I will say also opportunity lies into the diversification. Once again, in the hospitality industry, service apartment and student housing, for example.
Great. Jochen, where are you seeing the opportunities?
Well, I see them primarily in two sides. And as Frank said, on the operator side, there will be, as I said, I anticipate quite a lot of bloodbath over the next 18 months with operator going bust, having to be restructured, etc. So completely with Frank on that. And it's a perfect moment to enter into leases in terms of cycle, right? We are really at the bottom. So you can enter attractive leases as an operator if they are new leases. The other opportunity I see is in the conversion market. First of all, I don't see a lot of opportunities now because there's too much money chasing too few deals. We've been looking, actually, to be transparent about it. We've been looking at maturity schedules of mortgages in the hotel sector from banks, because whenever you have a big wall of refinancing occurring over the next 24 to 36 months, that's when, excuse my French, the shit will hit the fan. And therefore, there will be opportunities. And the assets that will be most interesting are the ones which don't have an immediate future with a lot of CapEx for conversions, adaptations, or whatever. And I would then go for, let's say, the top 25 cities, primarily not the metropoles like Paris and London, but the category of cities just behind across Europe.
Great, thanks very much, Jochen. And lastly, but very much not least, to you, Asli.
Yeah, look, as an operator, Cycas, we invested on our talent pool in advance, and as I say, we have actually remained open and keep opening our hotels even during COVID. So we now have extremely amazing teams across all 5 regions, covering of finance, commercial, and operations. So what is the big opportunity is that, of course, most, especially the PE funds, our capital partners, knew the strength of Cycas, both operationally and financially. So we are are now on the mood of takeovers, a large takeover. So we're looking actively portfolios with our capital partners, several assets across multiple countries where they want to acquire and need that. So I think we're going to carry on that and co-invest where we can co-invest, of course, and leases. We will look into development leases today rather than probably takeover leases, just because we want to still keep hiring the best-in-class talent rather than putting our monies into bank deposits this year and next year, and ride the wave that way.
Perfect. Thanks very much. Thank you for all of your questions. Really interesting discussion. My thanks to all of the speakers, and thank you to you for sharing lots and lots of different questions. Really interesting discussion.